While $10,000 won't be enough to fund a typical retirement, you might be surprised at how much it would pay in dividends alone. Perhaps it would be enough to supplement your income or pay for a vacation. Take a look at the different scenarios that would provide differing amounts of dividend income. The average person in the United States in their late 20s has approximately $10,000 saved for retirement. There are a variety of investments available to choose from that offer varied levels of dividend income. Nevertheless, the SCHD 500 index is likely the most popular investment option. This is so popular because it gives people access to 500 of the largest firms in the United States that have a track record of being stable and profitable. Additionally, it is well-balanced, which indicates that you possess a portion of each business and sector that contributes to the overall stock market. If you buy an ETF or an index fund that tracks the SP 500, you're going to get a dividend yield of less than 1.5%. The reason for this is because many of the biggest holdings are technology companies, which have a reputation for paying little to no dividend. With the $10,000 investment, you'll receive a dividend yield of less than 1.5%. This is what investors frequently refer to when they say the market. The Dow Jones Industrial Average, also known simply as the Dow, is another one of the most common types of investments. When investors talk about the market, they frequently refer to this other index, which is widely considered to be second only to the SEC 500. The Dow Jones Industrial Average, Dow, is a group of 30 of the most important corporations in the United States and is seen as a second indicator of how well the economy of the United States is performing. Investors who purchase a fund that tracks the Dow would receive a dividend that is slightly higher than the dividend paid on the SEC 500, which is just over 1.5%. Another option that would allow investors to achieve a higher high-dividend fund's dividend yield would be to purchase a fund that places a greater emphasis on providing higher income and less emphasis on capital appreciation. There are numerous options available that are of a high grade and hold stocks of reliable firms that have a lengthy track record of dividend payments. Taking as an illustration, the Invesco SAP 500 High Dividend Low Volatility ETF. This particular investment vehicle offers a dividend yield that is approximately 4%, which is considerably greater than the yield offered by the overall S&P 500. With $10,000 invested in this fund, the annual dividend income would be approximately $400 or $33 per month. There are many other high dividend funds available that are ideal for older investors. The reason that these funds are well liked by older investors is because they tend to provide more stability than other types of funds. The phrase sector funds. A person can achieve dividends that are higher than the average by investing in a fund that is specific to a certain industry or sector. For example, an energy fund will only hold companies in the energy industry. A healthcare fund will only hold companies in the healthcare industry, and so on. Certain industries and sectors offer higher dividends than others due to the nature of their business. For example, the energy sector is priced relatively low and has a high dividend yield because many investors are scared away from the volatility due to economic fluctuation. Renewable substitutes and regulations. One exchange traded fund, for instance, the Vanguard Energy ETF, has a dividend yield greater than 3%. The majority of a real estate investment trust's profits are distributed to its shareholders in the form of dividends due to the structure of the company. Real estate investment trusts are considered to have a moderate level of risk. Additionally, the Vanguard Real Estate ETF boasts a yield that is greater than 3. Investors who are willing to do some study and buy into industries that have recently gone out of favor have the potential to generate large returns on their investments. As the sectors become more popular once again, their gains would come from dividends as well as appreciation in the value of their investments. Income from an investment of $10,000 in the real estate or energy exchange traded fund offered by Vanguard would be approximately $300 per year or $25 per month. Individual stocks. Purchasing individual stocks is, of course, yet another option. However, many financial experts recommend purchasing index funds or exchange-traded funds, ETFs, if you're a beginner investor and don't have a large portfolio. By doing so, you can learn about market behavior while receiving stable returns and growing your portfolio without taking on too much risk. You may, at some point in the future, make the decision to invest in individual stocks if you are willing to undertake the necessary research and assume the associated level of risk. Dividend aristocrats. If you do decide to buy individual stocks, it is a good idea to look for companies that have a history of dividend growth. For instance, the list of dividend aristocrats is an excellent place to start because each aristocrat has a history of increasing its dividend for 25 years in a row. A dividend aristocrat such as AV currently pays a dividend yielding 4.5%. If you invested $10,000 in this company, you would receive approximately $450 per year or $37 per month in dividends. You would also receive any capital appreciation or depreciation depending on the future movement of the stock. In addition, it is prudent to screen those prospects by their fundamentals and ensure that they have reasonable payout ratios in the range of 50 to 60% or less. Positive earnings and a growing dividend yield. Offer to acquire. Individual stocks frequently go on sale for a variety of reasons, including recent negative news, a failure to meet earnings expectations, or the introduction of new management. This can create an opportunity for astute investors because the stock market has a tendency to overreact to news of this nature. However, in order to take advantage of this situation, investors need to evaluate the significance of the news and come to their own conclusion regarding the stock price. Those who are still relatively young should normally focus on personal development. A difference of just 2% in your annual rate of return can make a significant impact over the course of a career. For instance, an individual who invests $10,000 at the age of 25 and earns an 8% rate of return until the age of 65 will have a total of $217,000. However, if they had earned a rate of return of 10%, they would have $452,000, which is more than double the amount of money by the time they reach the age of 65. When choosing a growth ETF, it is essential to keep in mind that growth stocks are frequently more volatile than other types of equities, which can be challenging for investors who are not accustomed to dealing with market changes. An exchange-traded fund, ETFs such as Vanguard's Growth ETF or VOOG, is a fantastic option for younger investors. As the name suggests, it holds large-cap growth stocks such as Apple, Amazon, Home Depot, and other large stable names. Over the long term, a growth index will likely outperform the C500, which is ideal for someone who has many years until income will be needed. Because most of the holdings pay little to no dividend, instead they reinvest the profits within the business to continue growing at a rapid rate. The dividend yield from VOOG is less than 0.5%. As a result of this low yield, a $10,000 investment would only yield less than $50 per year in dividends, which is approximately $4 per month. There are many quality options that are comparable to this fund that provide returns that historically exceed those of the overall market. In general, an investor with a portfolio size of roughly $10,000 would be better suited, focusing on growth and neglecting dividends totally. This is because growth tends to produce higher return. How much of a difference would the income make in your life? Whether it's $50 or $400 a year, that amount probably won't amount to very much when it comes to paying your bills and funding your day-to-day needs. How much of a difference would the income make? Do not make the mistake of focusing largely on dividend yield in the early stages of your investment career. Growth stocks will bring you more money in the future when you're getting ready to retire. At that point, you could transfer your growth investments over to income investments if it makes sense. Growth stocks will supply you with more money in the future.